Welcome to Moments with our Investment Gurus event, where we showcase the thought leadership and capabilities we have at Momentum Asset Management. Before we start the session, just some housekeeping. We applied for continuous professional development points on your behalf. Our event platform will remain open until the end of August for you to still view this event and receive your CPD points. It is therefore important to please watch the full session and add your ID to the CPD section so that we can verify your attendance. The CPD certificate will be mailed to you after the Financial Planning Institute's accreditation is finalized. Please also feel free to ask questions in the Q&A section, and our investment gurus will either answer them live today or get back to you after the event. It seems that rare events are becoming increasingly more common. And as such, it's an opportune time to have our Investment Gurus event in the midst of a world that continues to be characterized by change. From a global perspective, US inflation is running at 40-year highs. And at the time of this recording, the potential risk of a recession is becoming increasingly real. The Russia-Ukraine war continues to grind on and have multiple effects that resonate around the globe, from the realignment of global politics, the rise of regional spheres of influence, and energy and food price increases that are adding to global inflation. Unfortunately, the recent events came as the world was just trying to get to grips with living with COVID-19 after the worst effects through the global pandemic. Even as pundits debate whether we were in fact close to the end of the pandemic. In converse, this has heightened the levels of risk we need to consider every day. When it comes to crisis, South Africa is not a country to stand back and not add to the noise. Load shedding, the finalization and the publication of the Zondo Commission reports, a president under pressure, together with the relaxation of exchange controls, as well as changes to Regulation 28, makes this an extremely dynamic environment. Navigating this world of uncertainty requires an open and an engaging mindset, a very steady philosophy, as well as a disciplined and a rigorous implementation of our investment ideas. Any investment idea needs thorough and diligent research, and as such, we've evolved our research focus through the establishment of a research hive, a point of coordination and alignment, as well as a great skill to build on our legacy of research excellence. This area will draw on the broader investment team to continue to generate practical and world-class research that has real-world effect in our portfolios. Hopefully you would have seen the most recent version of our Minefields publication, where we continually share some of these research outputs. Clearly, we live in a highly dynamic environment, a world that requires finesse and patience. As this is Women's Month, it is worth pausing and reflecting on the contribution women have made to investing. Our first speaker today will open our discussion with a thought-provoking topic, whether women make better investors than men. I already know the answer to that question, but let's in any case hear what Paul Nixon has to say. As we go through our focus areas, we have selected from our great bench of female talent to lead discussions on the global economy, our fixed interest opportunity set, and listed property. Sanisha Pakarisamy will give us an economic update. Zizanda Gila will give us an update from our fixed income team. And Maribana Letswalu will do the same from our listed property side. Stanley Bishu will be the thorn amongst the roses today and give us an update on our smart beta portfolios that have just achieved a very significant milestone. They've been running for 5 years and now have generated very commendable benchmark and peer relative results. We are very proud of the team and the track record that they have created. To conclude today's session, Tutor Blanche, our Managing Executive, will deliver some closing remarks. I hope you enjoyed today's session and are able to assess the talent and the insights we strive to continually build on and evolve for you as our clients. As I mentioned, August is Women's Month. Please keep an eye out for the initiatives and the exposure momentum we'll have to promote and celebrate female excellence. Thank you for joining us, and I look forward to hearing back from you. And if you do want to find out more, our doors are always open, and we are happy to take questions and engage with yourselves.
Hello everyone. Today we're going to share some behavioral insights, mostly from observed behavior, about female investors. That will hopefully answer the question of whether they do in fact make better investors. Now, I'm aware that a man explaining things about female behavior is almost precisely the definition of mansplaining, but I'm very happy to mansplain that women are indeed better at investing than men. The behavioral insights we've managed to gain are definitely worth sharing and in many cases confirm published research out there. I'd like to encourage all the female viewers though to participate in the upcoming poll and let us know what your experiences and preferences are when it comes to your own investments and those of your female clientele. When looking through published research, there appears to be a common consensus that women, in general, share one or more of four behavioral traits. Thoughtfulness and discipline. What was once lauded as a positive and very male characteristics of decisiveness and action orientation isn't necessarily a great way to approach long-term investing. Women are less likely to jump on the shiny bandwagon that is crypto, for example, are a bit more thoughtful about their investments and tend to stay the course a little longer. Curiosity and interest. Women tend to be more engaged and curious about the whats and whys of investing. They tend to be more considered and interested in the nuts and bolts of investing, how the instrument works and why it works the way it works. Trust in people and process. Women tend to get slightly better investment returns than their male counterparts. A Fidelity Investments study in the US have quantified this at around 40 basis points on average over 10 years. This has been attributed, however, to their tendency to trust and follow financial advice more closely than male counterparts who tend to be more overconfident. Openness to advice and collaboration. Women value partnerships and appear to be open or more open to collaboration with several financial planning professionals to look after their investments. They're also more inclined to value diversity on these teams. So women make better investors in general, but what about the evidence? Let's have a look at female investor behavior in discretionary unit trusts and non-discretionary living annuities, as well as stock trading on the Momentum Securities platform. Before we get into the evidence, let's perhaps recap on the machine learning exercise conducted on over 35,000 clients from 2006 to 2022. In essence, the technique used classifies each investment switch based on its proximity to other investment switches, where proximity is defined in respect of risk and return variables. The algorithm is searching for patterns or pockets of similar behavior and revealed four statistically significant behavioral patterns that we've labeled as the avoider is the first one, who is risk averse and usually switches to investments with the same risk and return profile. These investors tend to get a little stuck in conservative assets over an extended period and so pay an additional behavior tax associated with an inflation-related erosion of capital. The market timer is greedy when others are greedy and fearful when others are fearful. They switch the most frequently and incur the highest behavior tax in choppy markets. The anxious investor is comfortable taking investment risk, but at the first sign of downward markets, specifically a sharp market decline, they tend to de-risk their portfolios immediately. They incur the greatest behavior tax in market crashes as they inevitably miss the subsequent market recovery. Finally, the assertive investor is overconfident and least likely to follow advice. Assertive investors are constantly chasing past performance and up-risking their portfolios in the belief that they know better. Remember to download your copy of the 2021 Sci-Fi Report to dig into the behavioral archetypes in more detail. Now let's move on to the evidence. We examined three large groups of data. The first two being from the Momentum Wealth platform in unit trusts and living annuities, and the third from the Momentum Securities platform on execution-only trading accounts. So how did women behave in the flexible investment option or FIA? The following highlights stand out. The average female switches less than the average male, about 3% less. When they do switch, they switch less, about 4% less than their male counterparts. Females also incur 7% lower behavior tax, and the average behavior tax per switch is a lot lower for females, 16% lower in fact. It appears to be lower because they don't up-risk and de-risk their portfolios to the same extent as males. Past investment performance is not as much of a factor when switching. In fact, females chase past performance 25% less than males. Lastly, women have by far the biggest proportion of the avoider archetype, at about 40% of the population. This indicates that they are more conservative investors in general. This is also in line with the lower behavior tax paid by avoiders because they don't move money around as much and are also less sensitive to market volatility. Next, we move on to the retirement income option or RIO product. While the above differences are pronounced in retirement is where some bigger differences emerge. Retired female investors switch 61% less in the retirement income option. This results in a 29% lower behavior tax for females. The behavior tax in living annuities was much higher in 2021 in general when compared to FIOs, but women incurred far less behavior tax. Women tend to be more risk averse, and once again, when they do switch, they don't change their asset allocation as much as men do. With these significant differences in mind, we now turn our attention to behavior on the Momentum Securities platform. But before we delve into this, we need to chat about one of the more common behavioral biases, the disposition effect. To understand the disposition effect, we need to briefly take a look back at the watershed research published by Daniel Kahneman and Amos Tversky in the late 1970s. That changed the face of economics. Kahneman would later win the Nobel Prize in Economic Science in 2002. Unfortunately, his research partner had already passed in 1996. If we get straight to the essence of the research, it's all about that big blue dot in the middle of your screens now. The psychological value we get from investing is defined by something they refer to as the reference point. This point determines how we feel about something. If we think of stocks, the reference point starts off as being what we paid for the stock. If the price increases, we go into the green zone on the right. If it decreases, we go into the red zone on the left. The first thing you may have noticed is the size of the red block is much larger than the green block. This is because we don't feel the same way about the price of our stock increasing as we do about it decreasing. We experience around 2.5 times more pain when the price goes down than we do pleasure when it goes up. A little more complex than this, of course, but for today, this is all we need to know about the way we behave in the green and red zones. Because losses hurt more, we are naturally loss averse. We don't like them and try our best to avoid them, even if it means taking on more risk to avoid these losses. This is known as loss aversion. In the green zone, we become regret averse. We fear that the winning position will turn into a losing one. These two effects combined form the disposition effect. We're more likely to sell a stock in a winning position, or the green zone, to avoid the regret of that position reversing, and less likely to sell that stock in a losing position because that would result in a painful loss. Instead, we hope that the losing position will turn into a winning one. In general, research has found that the disposition effect is around 140% or 1.4 times. That means we're 1.4 times or 40% more likely to trade in a gain position. Remember, realizing those gains will also feel good. This effect, however, destroys value. We end up selling winners way too quickly and hanging on to losers for far too long. Against that backdrop, how do female investors fare in share trading when it comes to the disposition effect? We recently completed a large study of execution-only traders on the Momentum Securities platform. Just short of 10,000 traders in total and 10 billion rand in trades from 2016 to 2021. Roughly 37% of this population are women. Firstly, during normal market conditions or the pre-COVID period, there aren't any statistically significant differences in this behavior of men or women. Both groups are subject to the disposition effect and are approximately 1.4 times or 40% more likely to trade in winning positions, which is exactly in line with published research globally. Where this gets particularly interesting, though, is when we examine the post-COVID period, or from March 2020 onwards. During the heightened market volatility, distinct differences emerged between males and females. In 2020, males suffered from a heightened disposition effect of 228%, or they were more than twice as likely to trade winning positions over losing ones. The disposition effect for females, however, was far closer to normal levels at 168%. In 2021, the disposition effect for males was still well over normal levels at 185%, while the disposition effect for females subsides to 125%, or 1.25 times more likely to trade in winning positions. These gender differences were found to be statistically significant. The reason this is fascinating is that, contrary to what was previously accepted, is that females appear to be less loss-averse and regret-averse during market turmoil. They in fact suffer less from these emotional biases than their male counterparts. A 2021 study from Fidelity Investments in the United States showed that women were very confident in being the CFO of the household. Doing things like balancing the checkbook, yes, by the way, that's still a thing in the US, budgeting and making large purchases, for example. However, when it comes to the world of investing, women reported being far less confident. The results on your screens now show that only 19% of those surveyed felt confident in picking an investment that would align with their goals. Only 29% felt confident when it comes to investing for medium or long-term goals. And only 31% felt confident tackling retirement planning, for example. So what is the biggest weakness women have? This is perhaps a good place to wrap up. Returning to Daniel Kahneman, when asked if he had a magic wand, which behavioral bias would he make disappear, he almost immediately referred to overconfidence. It certainly appears the biggest weakness women have is the mistaken belief that they aren't good investors. Their natural disposition, it appears, is actually a significant strength. There is no doubt that women need to be more confident to get into financial markets, to get their money to work for them, to develop and harness financial security and independence. However, it appears that once invested, they're doing a pretty good job without changing much, although all investors have much work to do in eliminating their own behavior tax. With momentum investments, investing is personal. Understanding the investment behavior of South Africans is critical in helping us shape and tweak their investment decisions for better financial outcomes. Look out for our investment personality assessment, and please do reach out to me if you'd like to participate in the pilot study. See you all soon, and goodbye.
Thank you for joining us today. The COVID-19 pandemic is no longer the most serious concern facing financial markets as the world economy ambles forward from restrictive lockdowns. The post-pandemic recovery is now at risk from elevated geopolitical tensions, substantial inflationary pressures, and faster than anticipated monetary tightening. Russia's invasion of Ukraine has undoubtedly taken its toll on the world economy. From a humanitarian perspective, today's generation of Ukrainians have found themselves confronted with new horrors as Russia's military destroys entire towns and cities. Since the invasion began in February, women have suffered terribly from war crimes. But amid the carnage, countless Ukrainian women have inspired the world by taking on roles at the front line of the war. The Economist publication notes that unlike the typical war, which is short, Russia's invasion of Ukraine has entered its 5th month, and at the time of filming shows few signs of drawing to a close. With peace between these two countries remaining a distant prospect, the globe may have to live with a prolonged standoff. Although the Russian economy is still functioning in spite of sanctions, these are likely to remain in place for many more months and should weaken Russia economically over time. Similarly, Russia's first default on its foreign debt payments in more than a century is unlikely to have an immediate impact given Russia's low levels of foreign debt owed. But the default will continue to hang over the country like a bad rating hangs over people. Borrowing money at a later stage will likely be problematic given this year's default. Although the West is making progress on moving toward an embargo on the import of mineral resources from Russia, ongoing conflict could continue to have a boomerang effect on commodity markets in the interim. Russia's invasion of Ukraine has hastened the deceleration in global growth. Commodity price volatility, additional disruptions to global trade, tighter financing conditions, and softening external demand have all led to the World Bank revising growth lower in 70% of the economies worldwide. Growth downgrades to commodity importing countries in the emerging world have been even more extensive due to negative spillovers from the war in Ukraine and a further deterioration in the global environment. High and rising inflation was a problem even before Russia invaded Ukraine. Tangled global supply chains in the wake of the COVID-19 pandemic initially drove prices higher globally, but this was later on provoked by the extraordinary demand for goods in 2021, as countries emerged from lockdowns, allowing consumers to leave their homes and buy things with all the money that they had saved up during weeks of economic inactivity. But just as demand-driven inflation began to fade, and as global supply chain bottlenecks started to ease, the Ukraine crisis created new strains. The Russia-Ukraine war has left the world facing extended reductions to energy supply, severe sanctions that are likely to impact food security, as well as the inaccessibility of rare materials that are necessary in the production of key technologies. According to Forbes, more than 374,000 businesses worldwide rely on Russian suppliers, with the bulk of these based in the United States. The international domino effect of global dependencies has resulted in businesses grappling with inflation even after the initial inflation effects from the pandemic have worn off. As such, more stubborn and persistent inflation than initially thought possible has dominated policy discussions. The inflation surge has not been limited to wealthy countries, with poorer nations being hit by a similar wave. The World Bank shows that global inflation has risen substantially across the globe and is above central bank targets in almost all countries which have an official target. The primary drivers of the inflation surge have not been uniform across countries. Signs of an overheating economy in the United States have emerged from excessive demand driven by loose monetary, credit, and fiscal policies. As such, tighter monetary policy could actually be more effective in this economy to rein in inflationary pressures. Meanwhile, supply factors have played an increasingly decisive role in countries outside of the United States. This argues for a less aggressive stance on monetary policy or a more gradual response, especially in light of a further squeeze on real household incomes. The initial reluctance of the European Central Bank can be explained by the relatively less healthy economic fundamentals of the Eurozone, where the first quarter growth numbers showed that household spending and investment were languishing below pre-pandemic levels. The monetary union faces an additional challenge. Akin to the sovereign debt crisis that played out in the Eurozone between 2009 and 2012, lenders in European financial markets are questioning the fiscal sustainability of select member states and have now started demanding higher risk premia. Public finances are in a worse state today than at the peak of the previous sovereign debt crisis. The COVID-19 pandemic left lasting fiscal scars, but Russia's invasion of Ukraine has added to the Eurozone's fiscal woes. Decisions regarding sanctions, defense, refugee reception, and alternatives to Russian energy could prove very expensive. In particular, the burden on bank balance sheets will be greater in countries that face more demanding reforms. Keeping inflation at bay will require a tightening in monetary policy, which will raise borrowing costs. And together with declining growth, this could negatively affect sovereign debt sustainability in member countries such as Italy and other southern European debt nations. As such, the European Central Bank walks a fine line between supporting bond markets and gradually withdrawing monetary accommodation to fight inflation. Transport costs have similarly rocketed for emerging economies, but food inflation has hit these lower income nations disproportionately. Food accounts for a much larger share of the average household basket in developing economies, and as such amounts to a regressive tax, as pointed out by former chief economist of the World Bank, Carmen Reinhardt. The International Monetary Fund warns that higher than expected inflation adds to the cost of living crisis. The resurgence in inflation has reinforced inequality within countries and across regions, and now threatens to inflame social tensions. Analysts have warned that a more robust policy response from major central banks would be bad news for emerging markets in the short run. As funding costs rise, so does the risk of a debt crisis. But at the same time, delaying tighter policy would lead to even more draconian actions down the line, resulting in an even larger economic cost. Parts of Asia have defied the global surge in inflation despite suffering the same jump in commodity prices. Governments' management of the pandemic prevented dramatic swings in consumption from services to goods and back again. Less severe swings in demand meant less pressure for supply to respond. Moreover, Asia is still the manufacturing hub of the world, which means they suffered less disruption to supply. Now, without immediate inflation to worry about, the People's Bank of China can nurse the nascent economic recovery as tight lockdown restrictions begin to ease. Japan has likewise bucked the global wave of monetary tightening in a show of resolve to support a pedestrian economic recovery in spite of rapid falls in the yen. The Harvard Business Review notes that central banks' battle against inflation poses the greatest risk for recession. They warn that with inflation being a function of both demand and supply-led factors, it is not guaranteed that a recession would put out the fire of inflation. Now, although inflation remains harder than usual to predict, the Harvard Business Review points to signs of maximum inflation stress that are starting to ease. They note that demand is cooling and inventories have been rebuilding. In addition, workers are returning to the labor force and firms' pricing power is beginning to wane. Nevertheless, as the drivers of inflation shift from idiosyncratic factors into more sticky areas of the consumer basket, interest rates still have a way to go. The expectation of ever tighter monetary policy has driven longer-term yields even higher. Not only has this hurt the housing market through higher mortgage rates, but this has also contributed to a sharp fall in equity markets. The timing and extent of a recession boils down to the balance between taking the sting out of high inflation and how much stress the economy can absorb without falling over from rising interest rates. If central banks hike interest rates by too little or too slowly, inflation could ratchet uncontrollably to levels inconsistent with ensuring price stability. However, if central banks hike by too much or too soon, they could tip the economy into a deep recession. Although household balance sheets and the labor market remain robust in the United States, confidence has headed sharply south on higher costs. But there are still strong reasons to expect a milder slowdown opposed to a more damaging recession in the United States. Banks remain well capitalized and liquidity remains flush. Labor markets remain solid and balance sheets are in a healthy condition. Further contributing to the level of uncertainty around the pace and the peak in interest rates is whether a rising risk of a hard landing would tame central banks' resolve on inflation, given fears of the damage of a recession and the potential for a debt trap given the significant rise in liabilities in the previous low interest rate regime. Central banks will have to tread very carefully given reduced fiscal space. Bringing it back home, our own South African Reserve Bank, or SARB, is expected to continue front-loading interest rate hikes. Although inflation pressures are mostly visible at a headline level at this stage, the SARB worries that inflation persistence is setting in. Our own headline inflation forecasts of below 7% this year, but closer to 5% for next year, and a more moderate expected outcome on core inflation suggest that the interest rate view expressed by the forward rate agreement market is overly aggressive and would jeopardize already pedestrian growth. Growth in South Africa is set to slow to around 2% this year and then decelerate further next year after a strong rebound in 2021. Although growth in gross domestic product, or GDP, returned the economy to its pre-pandemic size in the first quarter of the year, many industries outside of services are still lagging. Employment gains have been more muted relative to the improvement in economic activity since the pandemic. Pedestrian growth and persistent uncertainty have prompted companies to scale back on fixed investment and operate with leaner staff. Employment levels remain lower than pre-pandemic levels in all sectors excepting for jobs in agriculture, which have grown only marginally. Akin to 2021, household spending is likely to be the primary driver of economic activity this year. However, declining asset prices, rising inflation, and higher interest rates could drive weakness next year. We are less optimistic about fixed investment providing major support to growth this year, given that nearly 60% of manufacturers rate insufficient demand as being a significant barrier to investment. What's more is that 80% of manufacturers in South Africa believe that an uncertain political climate is hindering investment prospects. Although the presidency's Operation Vulindlela has made remarkable progress on accelerating the implementation of prioritized reforms, political actions and government inefficiencies have derailed faster progress. We continue to flag unreliable power supply as a primary constraint to potential growth. While more intense load shedding and the damaging effects of the KwaZulu-Natal flooding will drive a meaningful slowdown in growth in the second quarter, higher interest rates, weakening global demand, and global recession fears will dampen economic prospects for the remainder of this year. Although the February national budget edged us in the right direction, there is still much work to be done to restore South Africa's fiscal position and to place the country on a more sustainable debt path. In our view, higher growth is necessary to achieve this. But without higher structural growth, large unmet needs in social spending, defunct municipalities, and unstable state-owned enterprises will weigh heavily on longer-term fiscal outcomes. Worryingly, endemic corruption has further eroded service delivery and socio-economic development. The Zondo Commission report, which serves as an investigation into the criminal mistakes made in our democracy in the past years, could cement genuine investor confidence if, of course, prosecutions follow. But more than that, there have been calls by many, including former public protector Thuli Madonsela, to have a designated body that can be called upon to oversee the changes in perpetuity. Indeed, as former United Nations Secretary General Kofi Annan said, good governance is perhaps the single most important factor in eradicating poverty and promoting development. Thank you for your time.
Good day and welcome to the session today. Our topic is titled The Return of the Yield to the Money Markets. In these uncertain and volatile times with so much noise in the market, cash assets provide certainty. Globally, the neutral theme we hear about in the financial markets today is inflation. Global inflation is rising. Central banks around the globe are tightening policy rates. The US Federal Reserve is getting very hawkish and hiking rates in aggressive increments, said to be targeting a Fed fund rate of around 3% to 3.25% for 2022. This rate is currently at 1.5%, and 3 expected rate hikes of 75 basis points remain until the end of the year. The story is no different in our local markets. Growth remains under pressure and has been revised down by the SARB. The rand has also depreciated strongly since the start of policy normalization in the major economies, as well as the slowdown in China's economy. Inflation seems stickier than initially anticipated. The SARB is concerned about inflation. Cash or money market then becomes a useful asset class to be in stress period like these, and can be a fairly decent hedge against inflation as the interest rates rise in line as the SARB tightens policy rates to contain inflation, especially in the short end. The key market rates we see as our main indicators or drivers of the local economy is the relationship between the JIBAR and repo, which basically gives a guide of where the short-term rates are headed, driven by either the market expectations of what the SARB will do next or bank funding requirements at various periods, especially the JIBAR rate. In 2013, the spread between the repo and the JIBAR widened and even reached 50 basis points after the implementation of Basel III regulations in South Africa. Banks needed to attract funding to buy more high-quality liquid assets, pushing funding spreads up, and has been moving in line over time until 2020, when the world was hit by the coronavirus, which forced the Reserve Bank to cut interest rates to stimulate the economy. And the spread went into a negative territory as the market expected further rate cuts. Banks were prompted to lower their NCDs as the market was long cash, as the banking system became a safe haven for investors getting out of risky assets. And this spread closed half the year at 30 basis points. Also, the term premium between the 12-month JIBOR and the 3-month JIBOR widened further to 240 basis points at end of June 2022 as a function of aggressive rate hikes priced in by the forward markets. And now, with the new Monetary Policy Implementation Framework, the MPIF, which will be implemented in the coming few months, where the SARB is looking to switch from a shortage to a surplus, the spreads on interbank funding rates are likely to be more closely aligned or pull towards the policy rate. We might see that gap closing. The South African banks are quite comfortable in terms of their capital reserves, and the bank's ALCOs hold more than enough high-quality liquid assets. Cash is becoming king again. The value is returning to the money market curve, gradually ticking up since the SARB stopped cutting rates in July 2020. Most investors are taking advantage of this steepness in the short end, which offers value even on fixed rate terms. The NCD curve continues to steepen, with certain points, especially in the front end, offering more value than the back end. Taking direction from the swap curve, the short end has been very volatile, pricing in aggressive rate hikes by the SARB more than the long term. Because of this action in the short end, over the past couple of months, the NCDs and senior bank spreads continued widening as well. But this is not alarming levels which could flag desperate need to attract funding, as the bank's balance sheets remain well positioned and sufficiently capitalized. We think this widening is on the back of aggressive interest rate hikes the market is pricing in. To the end of the year, the FRA curve is pricing in cumulative hikes of up to 130 basis points, and that action has spilled over to the bank's funding curve. The 3- and 5-year seem less convinced about the FRA curve's aggressive pricing, and that rates will remain that high for a while. Short-end yields year-to-date have moved between 120 and 140 basis points, while the long end added about 200 in the 3-year space and even lower in the 5-year, about 190 basis points. Again, on term investments, investors' preference has been prime-linked NCDs and floating rate notes, given the current interest rate cycle, also expected to affect the curve going forward. The change mentioned earlier about the SARB's proposal of the Monetary Policy Implementation Framework will have a significant impact for fixed income investors, since it is likely to result in changes to the supply and demand for certain instruments, especially at the short end. This will impact banks' in-store funding with possible compression, more especially in the front end. Banks will be less willing to pay up for short-dated funding in the form of NCDs and floating rate notes, which would drive JIBOR lower. However, this framework is not expected to materially change the bank's requirements for longer-dated funding. The back end will probably also move lower, but not as much, as banks will always need term funding. In this proposed framework, rather than the current practice of creating a money market shortage, the South African Reserve Bank would allow an excess supply of bank reserves, which it will then manage this additional liquidity by paying interest on qualifying reserves at the repo rate, followed by structural adjustment to the key market reference rates or a reduction in the JIBOR spread over the policy rate. With the overwhelming view from most central banks that rising inflation needs to be met with a strong interest rate hike, globally, interest rates are expected to rise. We see in the US that an aggressive interest rate tightening is becoming the norm, and the European Central Bank minutes published recently for its June meeting showed that some council members would prefer the ECB rate hike cycle to occur rapidly. We thought the South African Reserve Bank was likely to follow suit in its next MPC meeting, and it did. The governor said that the possibility of lifting the repo rate by 50 basis points at the July meeting was not off the table, and the fact that they acted sooner gave them space to move at a more measured pace. This convinced the market to not consider an aggressive 75 basis point hike at the July MPC meeting with reference to the Fed's recent move. Hiking the repo rate by 75 basis points was a shock to the market, as it expected 50 basis points hike in this meeting. As the fixed income team, we have factored in the upside surprise in inflation, as well as the downside risks to growth, the higher energy prices, excessive load shedding, and slower global growth. And in our view, the FRA curve is pricing in too aggressive, given our inflation forecast, which was lower than the last print. We had expected 50 basis point hike in the previous meeting. That is water under the bridge now, and looking forward, we see another 100 basis points coming between now and the end of the year. The quantum in each of the remaining meetings will depend on whether inflation has peaked and will ease in the coming months, or will continue to surprise on the upside. And we see the repo rate topping out at 6.5% by the end of the year. Cash has been yielding steady returns over periods and has outperformed equities and nominal bonds in recent months. Given the current inflation environment, it is no surprise that inflation-linked bonds had a good run. In times of uncertainty and market volatility, investors always regard cash as a safer asset class. Cash tends to outperform other asset classes in the short term, but when higher inflation lingers for longer periods, it erodes or eats away your expected cash returns in the long term. In closing, in this interest rate environment, money market funds will continue to offer attractive low-risk returns. With the underlying instrument floating in nature, the funds get the benefit of higher resetting benchmarks, like the JIBOR and the prime rates. And this seems to be the rewarding trend in this interest rate environment. Even though still below long-term averages, but better than the negative real returns we anticipated since the peak of COVID, when the SARB cut rates aggressively. It looks like cash is king and not trash anymore, and the king has returned. Thank you for your time, and goodbye.
When talking about inflation, Ronald Reagan, a previous president of the United States, who spent the first years of his presidency battling high inflation, once put it this way: inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. And in the recent months, every time I've had to fill up the tank, I certainly feel robbed. Good morning, everyone, and thank you so much for joining us. In today's update, we highlight the impact of higher inflation on the property market and where we are seeing real returns in real estate. As inflation continues to skyrocket, central banks across the globe have moved to increasing interest rates in an effort to curb higher prices. Here at home, since November 2021, interest rates have increased by 200 basis points, with further hikes expected in the short to medium term. Fortunately, the South African listed property market is well hedged against increasing cost of debt, with companies generally having a policy to fix more than 70% of their interest rate exposure. Currently, approximately 84% of the sector's exposure is fixed, with only 16% of the debt book exposed to immediate interest rate hikes. These hedges are generally fixed for 3 years on average, with 2 years generally the shortest hedge profile and 5 years on the longer end. But the risk certainly lies over the hedge. In the past year and a half, the 3-year swap rate has moved out quite significantly, with an increasing spread between 3-month JIBOR and the 3-year swap rate. This is impacting the rate at which property companies are likely to enter into new swaps when they expire in the current environment. However, notwithstanding increasing interest rates, the sector has actually been deleveraging their balance sheet on average, with loan-to-value ratios reducing from their peak of roughly 42% at the onset of the pandemic to just under 40% at the end of 2021. So how has direct property performed in a high inflation environment? Base rentals have reported an average annual growth rate of 8.2% during periods of rising inflation, compared to 4.4% when inflation was on a downward trend. The South African real estate sector has benefited from above inflation escalations, which are embedded into the lease term agreement. Historically, tenants were signing leases at escalation rate as high as 8%, But in recent years, we have started to see new leases being signed at marginally lower escalations, ranging between 6.5% to 7% and even lower in some instances. The downward trend in escalations, as well as negative reversions in the broader market, have put some pressure on base rental growth in the current rising inflation environment relative to historic periods. Coupled with that, direct property costs have seen above inflation growth, with rates and taxes, for example, having increased by 341% on a cumulative basis since 2006, which has undoubtedly put pressure on net property income growth. Having said that, since early 2000, direct property has provided total returns of 13.8% on average, compared to the average inflation rate of 5.5%. Property income has consistently averaged 9% during this period, while capital returns have not been able to keep up with inflation over the long term. We saw capital returns turn into negative territory in 2019 and were further exacerbated by the impact of the pandemic on property values. We have started to see valuations trough in some of the listed property companies, although some sectors, such as the office market, may continue to see declining valuations in the short to medium term. Listed property, on the other hand, has outperformed direct property since 2002, achieving total returns of 16.1% and real returns of 10.6%. In the past 20 years, the sector has only had 4 periods of negative real returns, including year-to-date 2022. And until the end of 2019, listed property consistently outperformed bonds, cash, and equities, having only underperformed the equity market on the wake of COVID-19, as property companies were some of the hardest hit stocks in the market. There is no doubt that a high inflation and high interest rate environment is likely to add pressure on the consumer's wallet, particularly lower to middle income earners who spend roughly 25% of their income on non-discretionary items such as food and personal care. Consumers are likely to start shopping down the value curve, and we will potentially see smaller basket sizes with a smaller proportion of consumers' budget to discretionary spend. In this environment, we continue to favor convenience shopping centers with a greater proportion of essential services, as well as rural and township centers with exposure to value brands compared to larger shopping centers. Having said that, we have seen larger retail centers making a comeback, with improving trading figures and footfall returning to these centers post the lockdown restrictions. Turnover growth in the Liberty 2 Degrees portfolio, for example, saw double-digit growth in the first quarter of 2022. In the office market, vacancies remained sticky at 16.7% in the second quarter of the year, having increased sharply from the pre-COVID level of 11% in December 2019. This equates to roughly 1.1 million square meters, which has been vacated in the past 2.5 years. The high vacancy rate continues to put pressure on asking rentals as the sector grapples with oversupply and very little new demand for office space. We do tend to see some flight to quality assets given the wide choice office tenants have at increasingly attractive rentals. This has led to some improvement in prime office vacancies in the second quarter of the year, recovering by 1.3% to 13.2%. It is difficult to find any green shoots in the office market, with vacancies expected to continue their upward trajectory as structural headwinds persist. However, it is worth noting that green office buildings generally outperform non-certified prime and A-grade offices on all metrics measured by the Green Buildings Council of South Africa. Vacancies in green buildings outperform their counterparts by 70 basis points, indicating tenant interest in green buildings. These buildings have proven to be a lot more efficient, with lower energy and water consumption, leading to lower operating costs and slightly better NOI growth. In the past 6 years, green buildings have shown a 2.6% annualized outperformance in total returns versus non-certified buildings. So although green buildings have certainly not gone unscathed, there is an investment case for green certified office buildings relative to their counterparts. From a development activity perspective, we have seen building cost inflation also increasing significantly in this current environment, having increased by 12.9% year-on-year in April 2022. This is likely to keep development activity at bay, limiting new development coming into the market in an oversupplied sector such as the office and retail market. Industrial developments, on the other hand, are still breaking ground, with some landlords having the ability to pass building increases to their tenants. We believe that the favorable demand and supply dynamics in the logistics market is likely to drive rental growth going forward. What has been topical has been Amazon's announcement stating that they may have overbuilt warehouse space during the pandemic when online shopping was heightened by retail restrictions. Since then, e-commerce sales have shown slower growth as consumers returned to brick-and-mortar shopping centers. We are of the view that demand for this asset class remains relatively strong, reflected in very strong vacancy rates and continued rental growth, despite reports of Amazon's quest to potentially decrease or sublet some of its space in the short term. Overall, we are starting to see net property income coming back to reality, or rather in line with inflation, with a sector NPI growth rate of 5.5% in December 2021. This is largely due to rental discounts and deferrals coming out of the system. However, we anticipate some continued pressure in net property income on the back of a slowdown in base rentals and increasing operating costs. I must say, overall, the windshield is certainly getting a lot clearer. A year or two ago, the sector was marred with a lot of uncertainty, and now, having passed through one of the toughest operating environments in the property sector, we believe that earnings have troughed and anticipate a recovery in earnings going forward. We anticipate that the improvement in the retail sector we are seeing on the ground will eventually translate into better rentals. The industrial market will likely continue to benefit from strong demand, and we expect further pain in the office sector. So in conclusion, and to once again borrow the words of Ronald Reagan in his address to the British Parliament, optimism comes less easily today, yet optimism is in order. And so, despite a weak operating environment and a slow start to the year in the listed property, we remain optimistic and are of the view that the sector remains very attractive with the ability to generate real returns in the long term. Thank you.
Hi everyone. I'll be covering the market update for this installation of Investment Gurus. The title of my presentation, It Rhymes, is a reference to the quote by Mark Twain that history never repeats itself, but often rhymes. The point I'm driving here is that historical analogies are a powerful tool to navigate a wicked complex problem, which is precisely what the global macro environment presents us. Sharp moving parts and multiple pivots. 2022 brought with it a spike in volatility and sharp drawdown in asset prices. When you look at the US equity market as an example, as measured by the S&P 500, that dropped more than 20% from its peak, moving it into technical bear market territory. For context, that is the worst opening to the calendar year since 1917. And that offers us a convenient segue to the decade of the 1970s, which offers many parallels with what we are seeing today. Let's take a look. The most obvious comparison and parallel that rhymes with what is happening today would be the soaring levels of inflation. For the entire decade of the 1970s, the US economy was plagued by stubbornly high inflation rates. In numbers, the average inflation for the entire decade was above 7%, a more than 3 times increase when compared to the previous decade of the 60s. Another layer of comparison that rhymes with what we're seeing today is that the inflation was driven by geopolitical conflict. There was a war in the Middle East. The USA decided to intervene by providing monetary support to one side of the war. In response, the oil-producing countries in the Middle East decided to install an oil embargo on the oil imports into USA. Within a matter of weeks, the price of oil quadrupled, sending inflation through the roof. At the same time, there was a food price spiral that was driven by a sudden drop in grain production, with Russia being in the middle of that. Moving to the second set of comparisons, stagflation. Right now, we have stubbornly high prices and high inflation, but there's also the risk that there will be a stagnant global economy with weak to negative growth and a downward revision in growth outlook. This is driven by a variety of factors. The outbreak of COVID in China results in lockdowns that weigh down on global economic growth. In the USA, the US Fed is tightening financial conditions by aggressively hiking interest rates, coupled with the unwinding of their balance sheet through quantitative tightening. We also have a fading of pent-up demand, as well as a rollback of some of the support policy measures that were put in place during COVID. The conflict in Ukraine and Russia is also weighing down on confidence and introducing a high level of uncertainty. The stagflation echoes very closely to what happened in the 1970s. This has very strong implications for the behavior of asset prices. When you take a look at corporate revenues or top-line growth, that is highly correlated to economic growth. And so the reduced economic growth will weigh down on revenue growth as well. Further, the inflationary pressure is going to have margin compression, which will be felt acutely for companies that don't have pricing power. Further to that, we're going to have heightened risks, given that there'll be an increase in the cost of capital for most companies. Moving to the third set of comparisons with the 1970s. The US president, at the beginning of the 1970s, decided to suspend the convertibility of US dollars into gold. This put an end to a global financial system that was underpinned by gold and introduced a new system underpinned by what we call fiat currency. Gold as a backstop to the financial system has a disciplining effect. It is an asset without a liability and does not require trust in governments nor policymakers. With fiat currency, in the wake of the global financial crisis, there was a trust deficit introduced into the global market. In my opinion, this is what brought cryptocurrencies into sharp focus as a potential to be a gold substitute. What we've seen over the past 12 months is a dramatic drop in the prices of most cryptocurrencies and coins. The conclusion we can make is that cryptocurrencies and coins barely meet the definition of money, in particular in their ability to be a store of value, and they definitely do not serve as a safe haven asset nor as an inflation hedge. Now, taking a look at these themes and how they transmit into capital markets, we will look at the global equity returns. We are taking a look at US dollar denominated returns for the 12 months to the end of June. Developed equity markets, as measured by the MSCI World Index, was down 14%. Most of that drop happened in the last 3 months. The US equity market dominates this index with a weighting of close to 70%. So the performance of developed equity markets is driven by technology, but also by healthcare and financials. Emerging markets lagged developed markets by more than 10%. China, the largest market, with a weighting of 35%, was a key laggard, ranking 21 out of 24 countries in terms of their performance for the 12 months to the end of June. The companies that dominate the Chinese equity market are Tencent, Alibaba, and JD.com. These are the top holdings, both in China and in the emerging market index. The emerging market losses were partially offset by oil-rich countries that benefited from a surge in the oil price. India, which has a large weight to reliance industries of about 12%, also offset some of the losses experienced by China. moving to rand-denominated asset class returns. In this graph, the bar that stands out would be the oil price increase of 46%. This increase is coming from a low base, given that there was a sharp collapse in the oil price as a result of COVID. Once the lockdowns were eased, there was pent-up demand, which resulted in a rebound in the oil price. This was further accelerated by the geopolitical conflict between Russia and Ukraine, which created supply-side shocks in terms of oil production. Gold over the period generated negative real returns, therefore offering low reprieve from inflation. Platinum prices dropped by nearly 15% after the post-COVID rally. This was driven by supply chain disruptions, creating a shortage in semiconductor chips. The production of a modern car requires roughly 3,000 chips. So this also created a bottleneck in the production of cars and the reduction in the demand of platinum. Fixed income returns were hampered by high inflation and rising rates. Nominal bonds and cash, therefore, were behind inflation in terms of their return. Inflation-linked bonds naturally provided an inflation hedge and were able to generate returns in excess of inflation. The local equity market, as measured by the capped SWIX, was broadly in line with inflation and therefore well below its long-term average real return. Financials were the best performer, driven predominantly by the banking sector, with Investec being a standout performer. It's worth noting that the financial sector is retracing losses suffered after COVID. So when you take a look at the performance over 3 and 5 years, financials are still lagging the other sectors. The resource sector continues to generate positive returns, driven predominantly by Sasol and Anglo, despite weak PGM performance. Listed property continues to suffer from weak fundamentals and structural headwinds. The industrial sector, which lagged all the other sectors, lost 6% in value, and this was dominated by the underperformance of Naspers and Prosus. Naspers and Prosus more than halved during the 12-month period that we're looking at. The long-standing discount to the sum of its parts worsened during this period. Management has been under pressure to unlock value for shareholders and reduce that discount. Prosus was a potential solution to reduce the discount, but that didn't work as anticipated. Another headwind, which triggered the sharp drop down in the share price, was the regulatory crackdown by the Chinese government. There was the potential of fines and the potential of more control on the activities, which would have impacted their profitability. Towards the end of the period, the share price rebounded strongly, and this was driven by the decision of management to buy back the shares and fund the buyback through the sale of the Tencent holding. We've covered a significant portion of the presentation, and the point I am trying to emphasize here is that there is a heightened level of uncertainty in the global macro environment, and that is spilling over into capital markets. We're seeing sharp moving parts and multiple pivots. All of this is happening in a condensed period of time. We are moving through different market environments and different regimes. And this has very different implications for the expected behavior of both asset classes and sectors, and also investment styles. As an example, I was having a conversation with Momentum's macro strategist, and we were talking about the inflation prints and how high those were. There was the fear of stubborn runaway inflation and how policymakers would work in terms of getting that inflation down. He made quite a strong point to say that a short 18 to 24 months ago, the conversation was not about runaway inflation, but rather it was about the fear of deflation. And that shows how quickly things can move and sentiment can move. So the question is inflation transient or structural? Is the commodity boom a spike or a super cycle? Do the ESG trends have a long-term impact, or would that fade away? So how do we navigate this uncertainty? Let's take a look first at the different ways you can approach the management of local equity portfolios. You have traditional active managers that rely on discretion and subjective calls to deliver returns in excess of the benchmark to their clients. You also have traditional passive investments where you're tracking the index and you're offering the benchmark as is to clients. Luckily, we're no longer in an environment where it's either or. And so our approach to navigating this uncertainty is that we break down the key drivers of risk and equity returns. We do this through smart beta or stylized beta. Effectively, what that is active management via index or beta replication. So we borrow heavily from systematic and rules-based methods of traditional index tracking to deliver active risk exposure and outcomes that resemble those of traditional active managers, and do so at a lower fee. The key part of delivering risk-adjusted returns above the benchmark is the exposure to what we call risk premium factors. There are three factors that we give exposure to in terms of the funds that we provide at Momentum Investments, which is quality, trending, and value. You can also combine these or blend them into a multi-factor solution. And this provides the ability for you to have an added layer of diversification where you can navigate different market regimes, given that each of these factors has a unique alpha signature, meaning that you've got a diversified source of alpha generation in the portfolio. Taking a look at the two funds that have a 5-year track record, the Momentum Trending Equity Fund and the Momentum Value Equity Fund. Both these funds have delivered strong outperformance in excess of 6% per annum since their inception. The key thing to note here would be the alpha signature of these funds. They tend to outperform at different times, meaning that you've got a diversified source of excess returns which enable you to create a robust portfolio with an added layer of diversification that allows you to navigate a wider variety of market environments. And that brings the end of my presentation. Thank you very much.
Good day, everyone. August marks Women's Month in South Africa, and the theme this year is Realizing Women's Rights for an Equal Future. This concept of equality is a global campaign and links South Africa to global efforts to achieve gender equality by 2030. At Momentum Investments, we recognize that the investment management industry in South Africa has historically not been gender equal, and we believe that the industry has been poorer as a result of this lack of diversity. We fundamentally subscribe to the principles of equality and diversity in our business. But more than this, we believe that gender diversity adds to the richness of the investment process and therefore leads to better outcomes for our clients. Women empowerment and excellence is therefore something that we at Momentum hold dear, and we're proud that 53% of all of our staff in the Momentum Investment Management business are female. We're also fortunate enough to have 45% of our senior management roles filled by women, including our very own CEO and CIO. I trust you've enjoyed today's session with us and found the content insightful. Thank you for joining us, and as always, we really appreciate your attendance and your support. The quarter since our previous feedback has been a busy one, marked by several themes that impact our clients and the industry at large. The global economic outlook has deteriorated significantly, with concerns around potential stagflation and geopolitical risks taking center stage. The world's equity markets have retreated significantly since last year, and the outlook for growth asset classes remains muted in the medium term. This will no doubt add to investors' concern and anxiety, and we need to keep a level head and stay focused on longer-term goals during this time. Recent Reg 28 changes now allow for up to 45% of retirement savings to be invested globally. While South African managers have agreed that the time may not be right to externalize assets to this extent at the moment due to the valuation of global assets, This will require the industry to reconsider the way that investment processes across local and global asset classes align in future. The trend to incorporate ESG principles in investment making decisions, but importantly, also being able to report on the impact of these portfolios on our society, continues to gather momentum. These are all challenges that we at Momentum also face, and we're designing strategies and plans for this at the moment. We already have a long history of incorporating ESG principles into our investment management process and constantly strive to improve our reporting to you, our clients. Through our research hive and in partnership with Rubico and our colleagues in London, we're actively exploring new trends and portfolio ideas, including the best response to the new offshore investment limits. Rest assured that we will leave no stone unturned to ensure that we respond to these challenges to achieve the best outcome for you, our clients. I look forward to sharing more of our plans with you as it unfolds. Allow me to quickly recap some of the key takeaways from the speakers earlier. Paul shared some fascinating research with us, showing why women tend to be better investors than men under certain circumstances. Another insightful observation was that the biggest weakness women suffer from is not believing the before-mentioned fact. Sanisha, on the other hand, shared a sobering assessment of the risks faced by financial markets and the state of the global economy. Top of mind for investors are inflation concerns, geopolitical unrests, and faster than expected monetary tightening by developed markets. Stanley showed us a comparison between what investors are experiencing now and what happened in the 1970s. He also shared that the last 6 months have been the worst start to a calendar year for global equity since then. Smart beta portfolios and a combination of various equity styles provides investors with a well-diversified and cost-effective portfolio for inclusion in any multi-asset strategy. We're proud of the 5-year track record and the performance our portfolios have reached recently. Zizanda showed that yield is returning to money market portfolios, and that in the current rising interest rate cycle we're in, this is expected to continue for some time. It'll be interesting to track the speed at which developed markets hike rates and what the SARB's response to this will be. And then lastly, Maribana shared her thoughts on an asset class that has really endured a tough last 5 years. It's worth noting though that over the longer term, listed property still delivered an attractive return to investors, and that most sectors are showing an improvement post-COVID. Some interesting insights from our team of experts, and I hope this will assist you in your understanding of the current environment and in managing your investments and those of your clients. Thank you again for your attendance today. Our audience has grown steadily since the launch of our webinar a little more than 2 years ago, and it's always a pleasure interacting with our clients through this channel. If you have any further ideas about content or what you'd like to see more or less of in future editions, please feel free to let us know. A recording of today's event will be available on our website on momentum.co.za under the Investments and Savings tab. If you've watched the full session, your CPD certificate will be emailed to you once the points have been authorized. Thank you again for your attendance, and happy Women's Month to all of our clients.